In this video, I'll show you how I trade options using probability and how I think in terms of expected outcomes. I'll also be placing my second trade of the year, and we have to check in on the trade from the last video. Quick context: if you're new here, I'm a full-time private investor, which means I make a living investing my own money. I run two accounts: a long-term portfolio focused on high-growth companies, and a short-term trading account where I trade low-risk probability-based option spreads. That's what we're focusing on today. I'll be showing real trades with real money, but this is for educational purpose only. This is not financial advice, and I'm not a financial advisor. It's just how I do it. If your goal is to eventually become a full-time private investor, make sure you subscribe to my channel and turn on the notifications. Let's start by placing a new trade. Today, I'm looking at Tesla. It's a stock I traded many times in the past, and it works extremely well for my strategy because of its high volume and high volatility. That combination means option premiums are typically higher than on most other stocks. Looking at the chart, we can see that Tesla has been trading in a range between roughly $380 and $500 since mid-September. At the same time, the longer trend is still up. We had a pullback since the end of December, and the RSI is currently around 42, which is near the lower end of where Tesla usually bottoms out. It doesn't mean I'm predicting anything, but it does suggest there's a reasonable chance that buyers are going to step in again and push this stock higher over the coming weeks. So I move over to the option chain, and I'm looking for expirations around 50 days out. My goal is simple: I want to find the lowest possible strike where I can still collect $4 in credit on a 20-wide spread. In this case, I'll sell the 390 put and I buy the 370 put. It gives me a 78% probability of success. This is above my minimum target of 75%. I collect about $4 in credit, and my worst case scenario is the 20 width of the spread. That's the same as $2,000 minus the credit received. So worst case scenario on this trade is losing $1,600. Let's log this trade in my trading sheet. I ended up getting filled at $3.97 in credit. That's fine, a little bit less than I wanted, but it's okay. And if this looks familiar, well, it's intentional. This trade is structured almost exactly like the Bloom Energy trade from my last video. Same risk, same reward, same probability. For me, consistency is everything. I want my winners and losers to behave the same way across all trades. Now, let's check in on the Bloom Energy trade from my last video. I opened the bull put credit spread on BE 7 days ago, and so far it's played out even better than expected. The spread has already reached about 63% of maximum profit, which means I can close the trade now for a profit of roughly $250, well above my $200 per trade target. So the question is, why not hold this position longer? At this point, it almost feels impossible for the trade to turn into a loser. But this is where discipline matters. The reality is, most of the profit in a credit spread comes early. Most of the risk stays until the very end. As time passes, the remaining reward gets smaller and smaller every day. But the downside risk stays almost the same. I can still lose $1,600 in this trade. So that creates a bad trade-off. You're tying up capital, you're exposing yourself to random market events, and worst of all, you risk turning winning trades into losers. That's not bad luck, that's bad trading. I don't chase maximum profit, I aim for optimal profit. At this point, it doesn't make sense to keep this position open for another month. Risking $1,600 to chase an additional $150 in profit, the risk to reward has shifted against me. So do exactly what my rules say. Take the win, close the trade, redeploy the capital. This trade is now closed for a $248 profit. Nice. The reason I love credit spread is simple. My maximum profit and maximum loss are defined the moment I enter the trade. It gives me control. In this strategy, I aim to make $200 on winning trades, and I never want to lose more than $600 on a losing trade. I'm not guessing, I'm not reacting, I'm simply executing a plan. Once you define risk and reward, you unlock something incredibly powerful: expected value. When I enter a new trade, I ask myself, what happens if I take this exact trade 100 times? Because that's expected value. For example, let's say if I win 70% of my trades, I make $200 on my winners, and I never lose more than $600 on my losing trades. Well, over 100 trades, that means that my 70 wins will add up to $14,000 profits. My 30 losses will be minus $18,000. That wouldn't work. I would be down with $4,000. So in this example, I would need to increase my average win to around $260 per trade, or increase my win rate to 75% just to break even. Now, these calculations assume I'm entering trades on completely random stocks. So the next question becomes, can I be more selective about what I trade and when I trade it in order to increase my expected value? Are there any tools I can use, for example indicators or even AI? Here's how I think about it. In the short term, Buying a stock is close to a 50-50 bet. Maybe there's 51% chance that the stock will go up simply because markets tend to go up over time. So there's a little bit of tailwind. But in my experience, it's almost impossible to predict whether a stock will go up or down over the short term. And by short term, I mean anything under 6 months. I fully accept that. I don't believe I have any special insight into the economy or the market that lets me predict any kind of direction. And I don't believe you can trade technical chart patterns either. That doesn't work. Never seen it work long term. Instead, what I focus on is using data to improve my probabilities. In the next video, I'll show you exactly how I select which stocks to trade and why I believe that process gives me an additional 2 to 5% edge. When you add that small edge on top of a structured, probability-based strategy, that's when you start to increase your win rate. And what would it mean to my results if I could increase my probability of winning from 75% to 80%, even 90%? This is where tools like Monte Carlo simulations become powerful. We'll talk more about simulations in another video, but basically a simulation is a great tool to help you test if a trading strategy is profitable, at least on paper. It doesn't predict the future, it doesn't tell us what will happen. But what it does, it simulates thousands of possible outcomes based on the probabilities we feed into the simulation. So in this example, I'm telling the simulation my win rate, my average win, my average loss, and how often I trade. Then the simulation will run 10,000 different outcomes over the next 52 trades. The reason why we're doing 52 trades is to simulate 1 trade per week for a year. Looking at individual trades is random, but the distribution of outcomes becomes predictable when we look at hundreds of trades. That's the whole edge. We're not trying to be right on the next trade. We're building a trading system where the math works over many trades. Now, look at this chart. This histogram shows the distribution of ending profit and losses after 52 trades. We simulated 10,000 different scenarios of the 52 trades. Most outcomes cluster in the middle range, and then we have tails on both sides. Some runs are unlucky, some are great, but the bulk falls into a predictable zone. In this case, we can see that with a 75% win rate, which is the blue one, it's pretty much a 50-50 bet whether it ends up winning or losing after 52 trades. But with an 80% win rate and an 85% win rate, which are the orange and green ones, most outcomes are on the profitable side of the chart, meaning it's more likely than not that this will be profitable long term. The conclusion is that if my expected value is positive, the strategy has a tendency to grind higher over time, even with drawdowns. In this table, we can see what happens when we run the same strategy many times. With an 80% win rate, the expected outcome over 52 trades is about $5,600 in profit. And the most likely outcome, the median, is about $5,200. To keep it simple, I'm going to round that to $5,000 per 50 trades. Now I can use that to work backwards and figure out how many trades I need each month to cover my bills. If I want to make $10,000 per month and my strategy produces roughly $5,000 per 50 trades, then I need about 100 trades per month. Okay, let's connect that to capital needed. On average, I hold a position for about 20 days. That's when most trades hit either the profit target or the stop loss. So in a 30-day month, I can recycle my capital 1.5 times. 30 days divided with 20 days, 1.5 times. So if I'm placing 100 trades per month, which are active for 20 days, then I'll have 67 trades open at any time. For each trade, I need to tie up $2,000 of my buying power. That's my broker's margin requirement. So I need 67 times $2,000, which is roughly $134,000. I hope that number doesn't disappoint you, because $135,000 is a lot of money, especially if you're just starting out. But here's the way to think about it. For most people, $10,000 per month is enough to walk away from a job they don't enjoy. That's not just extra income, that's life-changing. It's a full-time salary. Now, if this strategy performs the way the simulation suggests, at an 80% win rate, your yearly return on capital is almost 90%. So you're looking at a very strong compounding strategy here. Let's say you start with a $10,000 account and you compound consistently. With a 90% return per year, you'll reach the $135,000 in about 4 years only. And that's the key point. You don't need to start with $135,000. You just need to start, and you can start small, it's completely fine. Do this on the side when you still have your normal income. Let your capital compound for you. And if you stick with it, you're actually only a few years away from being able to quit your boring 9-to-5 job and become a full-time private investor. In 4 years, it's going to pass either way, So you might as well get started right now and set yourself up for the ultimate financial freedom. At this point, you're probably thinking that this sounds too good to be true, that you can make $135,000 in 4 years. That sounds crazy. And even solid strategies must have months or even years where losses outweighs the wins. And you're right, there will absolutely be times with drawdowns. In fact, this Monte Carlo simulation also shows us how bad it can be. If we're looking at the 80% win rate, the worst drawdown in the simulation is around $7,600. That's the worst of 10,000 different scenarios. That means from the peak in your account to the worst case is a temporary decline of about $7,600 before the strategy turns around and recovers. If I stick to $600 in max loss per trade, the drawdown would mean that I would lose 12 trades in a row. That's rare, but it could definitely happen. So the key point is this: drawdowns are not a sign that a strategy is broken. And of course, there will be losing trades. No trading strategy has a 100% win rate. But I fully understand how difficult it is to keep trading when you're just taking 10 losses in a row and you're down with $7,000. That's awful. Those are the times you don't even want to turn on your computer anymore. But it is part of trading. No strategy has a 100% win rate. The drawdowns, you have to look at them as the cost of doing business as a private investor. The key is though that you trust your system. Not blind trust, but trust built on data. That's why I spend so much time running simulations, tracking results, and analyzing performance. And that's also why, in my opinion, probability-based trading is the only realistic way to stay consistently profitable over the long run. Because when you understand the distribution of outcomes, drawdowns stop feeling like failure. It's just a part of the strategy and you already knew it would happen at one point. Still sounds too good to be true? First, I don't take any trades with less than 75% chance of winning. Second, I use 50% profit targets, which typically increase my realized win rate by roughly 10% because I'm taking profits early instead of holding for max gain. Third, I don't trade random stocks. I use specific entry filters to decide what to trade and when to trade. And that adds another 3 to 5% to my overall probability of success. None of these edges are dramatic on their own, but combined, they're exactly what allows this strategy to perform consistently over time. In my next video, I'll walk you through exactly how I select the stocks I trade. And if you don't want to miss it, make sure that you're subscribed to my channel. And if you have any questions, feel free to leave a comment below. I'm more than happy to answer any question I get. Thank you so much for watching. See you in the next one.